Hey, everybody. Welcome back to the second half of MDC 2021. I hope everybody is all revved up and ready for the second start of the day. Just a quick update. We had a little bit of a situation. We don't have Kamran today, so we're going to get that recorded. Going to get that sent out to everybody out there, so it'll be live on the. Oh, we do have Kamran now. That's wonderful. Awesome. Sorry for that. Just a moment here. So, in honor of Star Wars Day, little quote from Yoda is do or do not. There is no try. So, a little bit of inspiration today. Let's say, don't try, but do instead. So, a couple quick reminders. If you could, we really appreciate if you could click the feedback link or the survey and provide some feedback for any presentations that you see. It's very helpful for us in making sure we're able to continuously provide good content for everyone. Also, at 5 o'clock today, we're going to be doing a little bit of an after party where we'll be giving away some prizes and doing some drawings. So if you're able to, please stick around for that. It should be kind of fun. We think you'll really enjoy it. Kamran, are you with us? Can you hear us?
Yes, but my microphone's not quite ready yet.
Okay, great. We're starting to be able to hear you now. Apologies for the slight delay here. We'll be up and running in a moment.
Hey, how well can you hear me? Can't hear you. Hold on. Matt, sorry, I didn't catch that.
I can hear you very well.
Okay, that's fine. This is not my normal microphone, but it's not working, so we're just going to go with it.
Awesome. I cannot see your slide track though.
I'm just about to share it.
Fantastic. There we go.
Can you see that?
We can see that.
Okay. Yeah, sorry, I don't know what's up with my setup. My camera's not working either.
Hey, no worries. Well, from the beginning, my apologies. We are set up. We are live. Everybody enjoy the conference. I'm going to turn it over to Kamran
Ayub. Perfect. Okay. I'm sorry about all the technical issues, but this is going to be right up until the last minute. I'm probably even going to have to skip some stuff because this talk took me forever to make. So let's get into it. This talk is about money. But first, before we can talk about money, we have to understand our relationship with money. So I'm going to start by sharing how my money habits were shaped in majority in part by my grandparents. Those are my Grandpa Vince and my Nana. Never let her catch you saying grandma. These are my mom's parents. Nana had divorced Vince before I was born. Since my family never discussed money topics, most of my views about money were formed just from observation and conversation. I visited my grandpa fairly regularly growing up. He was in construction and built homes in rural Minnesota. He had a farm with big equipment. He worked at a powder coating business his wife's son founded. He lived in a house on a lake. He had a speedboat, which I loved riding. He had some four-wheelers, which I also enjoyed riding, and an original Nintendo with Duck Hunt, which I definitely loved. I sat in front of his big screen TV. It was one of those big boxy ones. It wasn't like this. He had a Bose sound system where we watched Star Wars and THX, and a sailfish mounted on the living room wall. I think it was fake. Nowadays, you can just buy them on Etsy. Basically, he worked hard and he had all the cool toys. I knew my grandpa had capital M money because you could see it. This is what having money looked like to me. And then there was Nana and Tom, her husband. I grew up with them. She watched me from the time I was a baby to school age, up to 3 or 4 times a week. She lived outside the city in a house with some woods and a marsh out back. She had one small TV that was probably like an old Magnavox or something with an over-the-air antenna I used to watch Sesame Street on. She shopped at thrift stores and got me used toys from garage sales. She gardened, had a compost heap. Her fridge was full of leftovers, Tupperwares, and saran-wrapped foods. Everything was saved. In other words, she was a frugal weirdo. Actually, that word frugal, we'll come back to it, because I only knew these were frugal habits reflecting back, because at the time I had no idea what frugal meant. All I knew was that this is what not having capital M money looked like. But let's talk about the value of time, because that is why my grandparents made such an impact on me. Whenever we'd visit my grandpa, he seemed to be working. Yeah, it was fun to ride in a Bobcat as a kid at a job site, and I attribute some of my enjoyment of home improvement to Vince, since I was able to see that firsthand growing up. But after a long day's work, he wanted to chill, watching TV or go out on the lake. He spent most of his time working. But Nana and Tom, Nana never worked full time. Nana got her nursing degree and always worked as an RM part time doing shift work because it was super flexible and she got paid well. She told me she never felt the need to work full time. That's how she was able to watch me during the week, and then she worked on weekends. Tom was in the Air National Guard. When I was a baby, he worked part-time as a weekend warrior, which meant he worked once a month on the weekend and once a week in the evening. When I was at Nana's, we did so many activities. I played outside in the woods. We played puzzles. We played games. We did Legos. We did arts and crafts every day. Nana and Tom were part of my daycare growing up. I had social interaction with other kids at regular daycare 1 or 2 days a week. When I was around 8, Tom left the Air Guard after 30 years. He didn't want to. That's the limit for how long you can be in the service. He ended up getting a 2-year associate's degree in computer networking at the local community college. That was when I got introduced to computers, and subsequently, my grandma's turned into a sanctuary for a young computer nerd. At this point, I was going pretty regularly during the summer, so I had a lot of time to tinker with these new PCs Tom was getting. We're talking about an IBM PC with a color monitor and printer setup. Plus, Tom would get new PCs pretty regularly. That stuff wasn't cheap. The price of a 1997 IBM computer was still about $1,000 or so. I had no idea at the time, of course. All I knew was I could play Doom to my heart's content. That time spent with Nana and Tom was priceless. Through them, I had access to computers at a very young age, a few years before we had them at home when my dad became a software developer. So no, growing up, I didn't think Nana was rich, but that changed when I was in middle school. Tom knew that when they bought the land initially outside the city, that it would appreciate in value. The acreage had prairie grassland and the state wanted to protect it. So Nana and Tom sold that land in excess of $1.5 million. Suddenly, Nana was rich. She could finally let the purse strings go. Maybe she'd get a mansion on a lake. Maybe she'd finally buy a new car. Maybe she could finally stop saving leftovers. Well, they did sell their house. They moved to a community with a country club. But that country club was way up in the north woods of Wisconsin, where seeing bears is a regular thing. They did build a new house, but it was a modest and normal-looking house. She always called it the cabin, even though they lived up there. She still bought stuff at garage sales. She kept saving leftovers. In other words, Nana was still a frugal weirdo. I didn't get it. Now as a teen, I'd joke with her and say things like, Nana, you have money. Why are you shopping at garage sales? Why would someone with $1 million shop at garage sales? I assumed she just had $1 million in her checking account. What was the big deal? I thought once you had money, like Grandpa Vince, you usually spend it on stuff, nice stuff. But it wasn't until much later, just a few years ago, that I had learned enough about personal finance that I could reflect back and realize how Nana's frugality and her wealth were connected. But we'll come back around to that. Nana and Tom didn't sit around playing cards at the country club after they quote-unquote retired. I'm 33, so they've effectively been in formal retirement for over 20 years now, and they didn't work full-time when I was a kid. Nana is 73 now, which means they sold their land when she was 58, and this would be called an early retirement. And when I was born, she'd have been 39 years old, and she had worked part-time since becoming a nurse and raising my mom and uncle. When they retired, they kept volunteering, kept active in their community. What the heck were they doing? How could they have sold their land at age 58 and still have money 20 years later? Did the $1.5 million last that long? Did Tom need to work? How could they do all that stuff and not be broke by now? To be honest, I never thought to ask. My parents didn't really talk about it, and so I didn't really think about it. And where was Grandpa Vince in the midst of this as I was a teenager and going to college? Well, he did retire from construction. I'm not exactly sure when, after Nana and Tom, I think. He ended up building his own house, which I thought was cool. He also built a neat warehouse with a home theater room that I enjoyed, and he even had some vintage pinball machines. I missed going out on the lake, but it was still a fun place to visit. He had a rental property in Hawaii and later switched to having an Airbnb in Tennessee. He had worked hard, retired, and then kind of did whatever he wanted. Relative to me, Grandpa Vince retired after Nana and Tom when I was a teenager. He still retired before 65, which is the traditional age, but his retirement looked different than Nana and Tom's. It was definitely more of what you'd think of as a true retirement without air quotes. He didn't work, but basically relaxed, did some hobbies, traveled to his vacation houses, spent time at home. Both sets of grandparents retired, but they arrived at that destination differently with two very different lifestyles formed by their money habits. For Grandpa Vince, he worked really hard, probably more than 40 hours a week, all things considered, had a traditional retirement, and then was able to spend time living his life. Throughout my time knowing him, he tended to spend money on things that you could see, status symbols, maybe you'd say. For Nana and Tom, they were frugal, saved much of what they earned, entered early retirement, and spent more time living than working. You couldn't see what their money bought as visibly. It was in the background, working for them to enable a more balanced lifestyle. The underlying lesson of this talk is that personal finance is personal. It's individual to you, and specifically, your money habits lead to having a certain lifestyle. And those habits can help or hurt you, and that sometimes we pick up habits we don't think twice about. This talk is about what I wish I knew about developing better money habits, habits that were clearly practiced by Nana and Tom, but were never explicitly shared with me or talked about. And what caused me to start thinking more intentionally about how I spent the money I earned and figuring out my why. I'm going to avoid trying to telling you what you should do because first, I'm a developer. I'm not a financial advisor, so none of this constitutes financial advice. But second, you aren't me, and your situation will be different than mine. Think about it this way. I'm about to share the source code of my financial life, but it's my code. It only runs on my machine. You won't be able to just git clone my life and expect it to run. Instead, I'll try to present a framework. You can use it to build good money habits, an FDK, or financial development kit, we'll call it. Well, what's the name of it? It took me a long time to stumble across it. You might expect me to say that I developed this FDK by talking to my grandparents and understanding how they were able to live such well-balanced lives. But that wasn't the case. My family never really spoke openly about money. We didn't discuss how the Dow and the S&P did over dinner, trade stock picks under the table at Thanksgiving, or gather around the family computer to rebalance our asset allocation on Christmas Eve. Until a few years ago, I would probably stare at you blankly if you started talking like this. Maybe you can relate? No, while I may have absorbed some of Nana and Tom's money habits through osmosis, I didn't have the faintest clue or really any interest beyond the fact that they sold land for a large sum, and that must explain it. I was a teenager and was absorbed in my own world trying to make some money for myself. During middle school and high school, I ended up learning web development and several programming languages like ASP.NET and PHP. My dad incorporated a business for me called Intrepid Studios. I did so much learning during that time, it was unreal. I thought it was really important that clients knew exactly what the latest software I used. I started out by doing logos, and then through a volunteer project, I was referred to a guy in New York City who built a website, and I made one for him and a bunch of his buddies. Hey, check out this teenager I found that's willing to make all our websites for pennies. Well, even though that's true, I really enjoyed doing freelancing. They genuinely liked my designs and helped pay my way through high school. The other thing I did for a year or so was run a BitTorrent search engine. I learned that I could make money with ads, and it wasn't insignificant. At its peak, the site generated probably $1,000 a month, which was like mind-blowing to me as a teenager, and still kind of is today. I shut it down after I started to get takedown notices. I don't need any of that. So here I was, doing freelance and running a website that threw off some ad income throughout high school. What was I doing with the money I earned? Well, I didn't have much expenses, so it was mostly typical teenage computer nerd stuff. I spent most of it though. I did manage to save some of it. Not as frugal as Nana, but maybe not as spendy as Grandpa Vince, somewhere in between. This in-between zone of not exactly spending everything I earned and saving a portion of it is a thread that continued throughout college and into my professional career, and I never stopped to think much on it. The little bit I saved was used up immediately as I entered college because my family didn't have a college fund for me. I went the student loan route, applying for FAFSA and other financial aid. My parents had been gunning for me to go to college, and I went along with it. After all, that's what you did after graduating high school. Since I liked doing freelance and having that business in high school, I figured I could learn more about that and combined interest with programming and technology. Started at the University of Minnesota Carlson School of Management in 2006, pursuing a management information systems degree. The cost for me to attend in 2006 was $65,000, which is peanuts because today my college attendance would cost $120,000, and I did the research and I looked that up online. I'm very glad that my parents encouraged me to do a work study program. I worked as a student web developer, and a portion of my paycheck went towards covering my tuition. I was so oblivious that I don't even know how much it covered. I can't look back and check pay stubs, but by some act of Deus Ex Machina, I had signed up and connected my bank accounts to Mint.com in my senior year, which was 2009. If I look at my spending on loans, the math works out to my work study covering about $8,000 of my cost of attendance. During college, my wife entered the picture. Well, she wasn't my wife back then. We got married later in 2013. She graduated without student loans. She was a goody two-shoes high school valedictorian and received a National Merit Scholarship that covered tuition to the university. She also applied to work as a community advisor in the dorms, which covered room and board and provided a small stipend. She also didn't spend much. Hot, smart, and frugal. I lucked out on that one. She double majored in psych and French and wanted to become a social worker. To do that, she needed a graduate degree. In order to pay for that graduate degree, she took out a student loan, which cost $37,000. On top of our student loans, we only had two other loans for each of our cars. Mine was $19,500, hers was $12K. The reason hers was so much lower was that I'd gotten a new Toyota Corolla my senior year, and I had the sense, but I did have the sense to help Cassie find a used 2010 Hyundai Elantra. She didn't have a license and couldn't practice to be a social worker until she had her degree. After we graduated in May 2010, she worked downtown at Macy's, and I joined General Mills full-time as an application developer level 1. She made $7,000 in 2010. I made $40,000. In 2011, she made $16K, switching to work at a daycare downtown, and I made $60K. In 2012, she was still finishing a degree, so her income stayed the same. I became an app dev level 2, so I bumped up to $65K. These were our first 3 years together out of college. We had separate finances as we were still dating. In 2012, I proposed to her, and then we got married in 2013. And after that, we combined our finances. We were officially a household. Our lifestyle and spending didn't feel too extravagant after college. We got a nice one-bedroom plus den apartment in South Minneapolis. We had 2 cars. We cooked and ate out with friends. But those student loans really hurt. Once Cassie got her master's degree, she found work at a nonprofit in 2013 and had a salary of $40K. You can do the math. We were officially a 6-figure household. Things felt good. During this period, a friend at General Mills shared a system with me to automatically transfer a portion of my income to a savings account. The way it works is that when you get paid through direct deposit, you can choose how the money gets split. You specify fixed or percentage amounts that go to savings, and the rest goes into your checking. It never occurred to me that direct deposit could work like this. I just thought it could only go to one account. The other system that got put in place without me really paying attention was my 401k. General Mills automatically enrolled new hires into the 401k plan unless you opted out. The material they gave me explained that they offered something called an employer match and that I should at least contribute that amount or above. General Mills matched up to 3% of my salary, so I contributed my 401k starting at 3%. They also automatically increased my contribution by 1% each year, unless I told them not to. And as you can probably guess, I just left it alone. I had no idea how my 401k really worked and thought, well, that only mattered when I was way older. I didn't come to appreciate how important it was until 2015, when me and my wife had a wild idea. I'd proposed to my wife while on a trip to France. Remember, she had double majored in French, so she was fluent and had visited before in high school for French class. Well, shortly after we got married in 2013, she said, "I've always dreamed of living in France." And to that I said, "Well, why not? Let's do it. We don't have kids. We don't have a house we're paying for. I bet I could work remotely. You could take leave from your job. Let's figure it out." We did figure it out. This was the first time since high school it felt like I actually woke up from this stasis of being on autopilot and following the one-way signs in front of me. So I dove in headfirst. We researched what it would take. It took about a year of full-on planning to make my wife's dream come true, but everything was looking good. We navigated the bureaucratic visa process, which involved so much paperwork, chicken and egg crap, and finally we had to be interviewed on site at the French consulate in Chicago. We switched our apartment to month when it was time to renew our contract in 2014. I found an apartment to rent on HomeAway, which was like Airbnb for long-term rentals, and we lined that up with the landlord over there. I made plans to get us a storage unit to put all our stuff in while we were gone. We bought our tickets. We'd be leaving in December 2014, arriving right before Christmas. Throughout this whole time, I didn't have to think about the money situation too much because the rent we'd pay in France was similar to what we paid in the States, plus the storage fees. I've been talking to my manager and leadership to inform them of our plans. They said they supported me. Shouldn't be a problem. I was basically approved to work remotely. Except I learned that in corporate America, nothing is official until HR signs off. And apparently for the entire year we had been planning, no one had really informed HR of my plans. So less than 2 months before we were set to embark on this epic adventure, HR finally got involved. A consulting company was brought in. Fancy people did fancy math. They found that it would be too big of a liability for General Mills to allow me to work in a foreign country, even though I had done some research already where it sounded like it should be fine. But whatever, I couldn't argue with consultants. I was told, sorry, can't actually work in France. Suddenly it looked like this dream was about to be crushed. But then, by way of an apology, my leadership asked if I wanted to take a sabbatical instead. Sabbaticals were available to employees who had worked for at least 7 years, and I had only been there for 5 years, including my internship. I wasn't sure. A sabbatical? You mean I wouldn't be making any money? Oh, well, let me get back to you on that. So here we were, tickets in hand, everything lined up to leave our apartment next month, and this whole time I had planned to be working. I had to finally sit down and take a good, hard look at my financial situation. The first time, I really had to pay attention. The situation looked like this. Through our automatic savings, we had saved up about $10K over the past 4 years since graduating, and we had about $5K in checking, so we were starting with about $15,000. I took a look at our expected monthly expenses like rent, loan payments, insurance, utilities, cell phone, internet, all that, what they were here and what they would be in France. It worked out to about $5,500 a month. That was unfortunate because that meant we could barely afford 3 months abroad. And realistically, it would be more like 2 months because we didn't feel comfortable having $0 in the bank. I needed to do some more financial gymnastics. Could we make more room? I took a deeper look at our loans. We were paying $975 for student loans and $525 for our cars. I learned we could request something called a forbearance on our student loans. Forbearance is a way to put a hold on loans so you don't have to pay them. Well, that sounded perfect. That would save us almost $1,000 a month. But of course, there's a catch. Your loan keeps collecting interest. I knew a bit about interest at the time and that it sucked, and this is why I had always paid more toward my student loans than the minimum required. But that's about as deep as I went. I didn't really do the math on how that would work out. I just thought since we made enough, we'd be fine. This was a once-in-a-lifetime experience. That managed to reduce the expected monthly expenses by $975, bringing the total down to just under $4,500. The remainder of the loan payments were going toward our cars. So I dove a little deeper and discovered that since I had done 0% financing on my Toyota for 5 years, I was actually going to pay off my car right before we left. Without my Corolla payment, that freed us up another $325, which lowered the estimate to $4,300 a month. I started to create a spreadsheet with the month-to-month cash flow of money in and money out and what our expected bank account balance would be. At this point, I was realizing that even a several $100 difference made a big impact because now we could safely expect to do 3 months and still have a buffer for when we got back. 3 months was really good, but then we began to ask what it would take to stretch the sabbatical to 6 months because we originally wanted to stay a full year abroad. The math worked out to needing another 10K to make that happen, but again, we weren't comfortable without a buffer, so really we needed like 12K. Where in the heck could we get another 12K? I explored getting a personal loan. No, the approval process for that would take weeks. I was starting to lose hope. We really only had 2 or 3 weeks to go before we had to make a final decision. I Googled around for more loan options, a home equity loan or line of credit. Nope, didn't own a house. Then I came across an article mentioning that most 401k providers allow you to take out a loan and borrow from your available balance. Could it be? A spark of hope. How do I do this? Remember this slide from earlier. This was the first time I really looked at my 401k. Like really looked. It had basically been running behind the scenes, and frankly, I was astonished at what was happening in there. All I saw when I looked in December 2014 was that my balance was over $100,000. From starting at zero when I started my job to December 2014, my balance had grown to over 100K. Holy crap! Now I had to make a decision and make it quick. I could take out the 12K I needed, but I could also take out way more than that if I wanted. The articles I was reading explained the trade-offs of taking out a 401k loan, and my wife and I talked about them together. A 401k loan is different than making a withdrawal. If you withdraw funds from a 401k earlier than age 55, you pay a 10% penalty on top of any taxes you might owe on that withdrawal. You can borrow up to 50% or 50,000 of your vested balance, whichever is lower. Payments to your loan are strict. There's no grace period for paying it back. And in my case, I could only pay it off with a lump sum. I couldn't pay more each month. There's interest on the loan, but you're essentially just paying yourself back. But the best thing about it for our situation, I could request the loan and it would be deposited into my bank account within 1 to 2 days. There's no qualification or approval process. That's because a 401k loan isn't technically a loan. It's just structured like one. So this all sounded pretty great for us, really. But there is one major drawback, and it's one that isn't obvious unless you understand how 401k works. That is, you lose out on any potential future growth. At a high level, I understood that this was bad because the money I took out would lower the balance of my investments, so my balance would take a hit if there was growth in the portfolio. But I didn't understand this at a low enough level where I actually tried to calculate the impact over time and run a full financial model. I mean, who would? I didn't have a financial advisor and I wasn't well versed enough to truly understand what to even calculate. I was under time pressure. I had to make a judgment call with only 2 weeks to go. Either we were going to take out the 12K from the 401k to live in France for 6 months and achieve my wife's dream, or we were going to have to cut that dream short by 3 months. We chose to take the hit. After all, we never thought we'd get a chance to do this again. I was going to return to work when we got back, and I was making enough that I felt confident we could pay it back sooner than the 3 years the payment terms were set out for. We were going to France for 6 months, and we'd be traveling around Europe based on what our budget allowed. Everything worked out. The finances, staying in France, visiting other countries, meeting new friends, everything. It may not have been the most financially sound decision to take out a 401k loan, but it was intentionally done, and it was the best life decision we made up to that point. Not having to work for 6 months ended up being a blessing in disguise because we escaped the 40-hour work week, and sometimes more, to slow down. I paid attention to my finances more than I ever had in the past. We budgeted all our trips and tried to save money wherever we could. We ended up hitting Amsterdam, Morocco, Ireland, the UK, Norway, not to mention taking the train around France. We ended the trip by visiting Italy with my wife's family. A once-in-a-lifetime trip had been accomplished. We returned to work. We made plans to start a family. We rented a house instead of an apartment. I paid off the remainder of the 401k loan within the first year of coming back. We had our first baby, a boy. We started paying for daycare. It was way more expensive than I expected. The student loans resumed. My wife was growing to heavily dislike her job, and it was around 2017 when money started to feel a little tight. It had come to my attention that I was making much less at General Mills than what my friends were making elsewhere, so I decided to quit and join Target in 2017. This came with a good bump in my base salary, which alleviated most of the financial stress. We made plans to have a second child. We bought a house in the Southern Metro for $305,000. The calculators I used said we could afford a $700,000 house, but thankfully we had the sense to draw a line in the sand well below that. If you think that's because of our in-depth experience planning our sabbatical, nope. It's just that we hadn't been saving a whole lot extra for a big down payment. I told my wife that it was recommended we put down 20%. That would be over $60,000 at our budget. We both thought that wouldn't ever be possible. Who could even save that much with daycare and rent and student loans and car payments? It felt like we couldn't save any more than we already were. In fact, I hadn't increased my contribution to our savings even after having made significantly more income, and it wasn't even back up to the point before our sabbatical. I feel embarrassed to even admit that, but it's the truth. So our down payment was 5%, and we didn't even have all the cash on hand. We were put into another situation where we had to find money on a pretty quick timeline. Did I take out another 401k loan? In fact, that was my first thought. But my 401k wasn't available to me at Target until 6 months after I joined, and this was only 5 months after I joined. This turned out to be a good thing. I benefited from yet another decision I made in the past without thinking. Back in 2012, a close friend was alarmed that we hadn't opened any IRAs given our income level and advised us each to open one and set aside some savings to contribute. An IRA stands for Individual Retirement Account, and he explained that there are two main types, traditional and Roth. If you have a business, there's also Simple and SEP. Oh, and MT and Me or Vista. Ugh, the financial world is just as bad as Microsoft at naming things. Well, what should I pick? Traditional or Roth? It was harder than picking out what framework to use for a new project. Depends on your situation. There are tons of rules and exceptions to those rules, and there's stuff about tax and after tax and deductions and income limits, and oh my God, make it stop. I was so overwhelmed. I just went with opening a Roth IRA for myself. I didn't even bother to open up one for my wife because it already felt like we couldn't save much in them anyway. I set up automatic transfers amounting to about $600 a year and then promptly forgot about it since I wouldn't need it until retirement. Well, little did I know. My friend's sage advice had resulted in me having a balance of $6,700 in my Roth IRA by the end of 2017 when I was looking to buy a house. It turned out you can withdraw money out of your IRAs penalty-free if you're a first-time home buyer. How fortuitous. In fact, this is something you can do with a Roth IRA anytime, with the caveat that you can withdraw from contributions penalty-free, but you need to pay tax on any earnings you withdraw. That's because you've already paid taxes on contributions to your Roth when you put them in. And if you're a first-time home buyer and you have a traditional IRA, you get the same benefit, since you normally have to pay tax on any withdrawal from a traditional IRA. So I took the $5,000 I needed for our house, called it a day. We're in November 2018, a year after we bought the house. My financial picture is looking more like this. My daughter was just born, healthy, which we were thankful, but now I was looking at paying twice as much for daycare, which was already $12,000 a year. Plus, and this is again embarrassing, but for the past year or so, our checking account would have an overdraft because of large payments. Remember that system I had for sending automatic savings? Well, I kept having to fiddle with the amounts or percentages because I kept underestimating how much we needed to deposit into our checking account to keep it from going below $0. So I get a notification, then I have to scramble to transfer money from savings back to checking. It wasn't that we had no money, it's just that I had no idea how much we actually should be keeping and checking. I just didn't get it. How could this be happening? With my developer salary at a Fortune 50 company being around $150,000 and Cassie starting a new job at a school in the fall making just under $60,000, our household income was higher than it had ever been before. And what about our lifestyle? It didn't seem that extravagant. We made a lot of meals at home, and yeah, we ate out occasionally. We weren't living in a custom-built home. We still had the same cars that were now fully paid off. It felt like we were fairly frugal, and it didn't feel like we were spending much. How is it possible with our income that most people don't have, we could even conceivably have money issues? I blame the big expenses we were saddled with: loans, daycare, and the mortgage. The problem was simple. We were on autopilot since getting back from sabbatical, focused on getting more money in, focused on starting a family, buying a house, to the exclusion of everything else. We were neglecting our financial health. We had our finger off the pulse. I can remember the day it happened. I had just started paternity leave for 3 weeks, 2 weeks, 2 weeks paid, 1 week unpaid. It was October 25th, 2018, and I was browsing Twitter, and suddenly this tweet from Corey House came across my timeline. He mentioned some account called Mr. Money Mustache, and then quote tweeted a video from PBS NewsHour. I was intrigued. Let me play a little snippet of this for you. I'm hoping that this comes through. Let me pause and resume. Here we go. All right, let me unmute this.
Pete Adeney almost always leaves his Longmont, Colorado home on 2 wheels instead of 4. It's a lot cheaper. For 7 years, Pete, aka Mr. Money Mustache, has been preaching parsimony on his popular blog. And he sure practices what he preaches. How much do you spend a year?
We don't budget, but it seems to always end up around $25,000 to $27,000 per year for the family of 3.
25? What the heck is happening here? Hold on, let me switch back to the presentation. How do you mean a family of 3 spends $25,000 a year? How am I 31 and these people are done working at 35, retiring early? He talks about index funds. What are those? He talks about the 4% rule. What is that? I was questioning everything I had ever known about money before that point. That was the day I had accidentally discovered a repository for a framework called financial independence. I had found my financial development kit. Now, in game dev, there's a construct called the main loop. This is what runs the game simulation, updates state, move things around, renders things onto the screen. Then it does it all over again, usually many times a second. This financial independence framework has a main loop too. It's earn, save, and invest. Earn the money by working or through other means. Cover your expenses, save the rest. Stash those savings into assets that grow over long time horizons. In a game loop, each individual step has a responsibility, but when you run them together in the right order and repeat that process over and over, you get the Witcher. With FI, financial independence, it's the same. There's a compounding effect to your investments over time, and those investments throw off income that becomes enough to cover your expenses. You become independent from your finances. Your money is working for you. Just like any good framework, the tools and concepts of financial independence lay a foundation to build on top of. Software metaphors often revolve around building houses, so let's use one. This is the house of FI. When you have a level foundation, everything you build on top of it is level 2. On the earning side, you've got different kinds of income like W-2, 1099, royalties, rental income. That income comes from different working models: employment, side hustles, freelancing, business owner, landlord. Under saving, there are different systems and habits to help you save, to be frugal. Systems like meal planning, house hacking, pay yourself first, and then all the frugal habits you can employ: cooking, buying used, biking, renting, DIY, geo arbitrage, couponing, countless others. And where do your savings go? To buy assets. Assets are like vehicles: stocks, bonds, index funds, real estate. Those assets are parked in garages. A brokerage account, IRA, retirement account, HSA, money market account, and many others. Some of these things I had heard of or seen examples of throughout my life, but nothing tied it together all like this. Now, I knew the concept of retirement, and financial independence encompasses that. But retirement is a point in time. It's the moment where you stop work. But FI is a framework that consists of all the habits, systems, and tools that enable you to reach that destination. That word retirement also brings to mind a far-off, distant future for a young adult or a college graduate. But in reality, that retirement date just comes down to math. Some really simple math. Some would say shockingly simple. After I watched that video, I checked out this guy, Mr. Money Mustache's site. Now, let me just forewarn you, after having been in the FI community for a couple of years now, Mr. Money Mustache is not a gentle introduction to financial independence. He's got a persona. You could go and read this post, but since this is a talk for developers, let's write some code instead. The time it takes to be, well, I'm not going to say retirement because of the images it brings to mind. Let's call it work optional. You've bought yourself time by saving money. It turns out that your time to becoming work optional is entirely dependent on one number: your savings rate. Your savings rate is broken down into 2 parts: how much you take home and how much you spend. If you spend 100% of what you earn, you can never stop working. And I apologize for the highlights here. Unless someone is saving for you, like a pension, Social Security, or your parents, you will work until you croak. Your working timeline is infinite. But if you spend 0% of what you earn, you live for free. Your working timeline is 0. You could be work optional today. So if both those extremes can be true, what's this in-between state? Well, to write the code for that, we would need to do some projections on a timetable and do a for loop and a whole bunch of other stuff. But you know what? We're already running out of time. So instead, let's bring up a calculator that someone else has already made. Now, I've plugged in my own numbers in the year before I discovered the concept of financial independence. And it turns out we were doing slightly above average. I mean, saving around 14% of our income. With changing nothing else and maintaining that savings rate, we'd both be working for about 27 years, or until about age 56. But here's where it gets really interesting. It was a lot easier for us to take control of our spending than it was for me or my wife to try and earn more. I'd already switched jobs to try and earn more, and it didn't feel like it was working. That's because, in reality, our savings rate had only increased by a few percent since I had joined General Mills in 2010. Most of our savings was in my 401k, but over the years, we had introduced some more accounts like my wife's 403b at work, the Roth IRA, courtesy of our friend, and after joining Target, I'd opted to get an HSA and a daycare spending account for the kids. Thanks to the automatic contribution increase I hadn't opted out of at General Mills, our savings rate had grown slowly without us paying much attention and was at 14% after I joined Target. Those percentages in my 401k had been here the whole time, staring me right in the face, and I never put two and two together. I never understood how it worked, the overall system the 401k fit into. It was just the one thing that I dealt with once a year. Without understanding how our savings rate impacted our finances, I was fixated on earning more, just the first pillar of financial independence. But I neglected to spend time on the second or third pillar, saving by spending less and then investing the rest. After I discovered financial independence in October 2018, the timing worked out because my daughter was born a month later in November, and I had 3 weeks of paternity leave to take stock of my finances and reflect on everything leading up to this point. I went all in, absorbing everything I could about this concept. We were able to do a 180 on our finances within a year. Starting from a 14% savings rate in 2017 that carried into 2018, we cut our spending by about 40% by the end of December that year, which raised our 2018 savings rate to 23%. We kept practicing better spending habits, which rewarded us with a 43% savings rate in 2019. And in 2020, we reached the 50% savings rate. To accomplish this, I just absorbed as much as I could about financial independence. I listened to podcasts, read books, read blogs, asked questions in the community, and more importantly, I took action. The first thing I dove into more deeply was learning about investing. In the FI community, there's a guy named J.L. Collins who has a blog, and he has a long series of posts called the Stock Series. He wrote the series for his daughter, but it became so popular, he collected and edited the posts into a book called The Simple Path to Wealth. For God's sake, don't buy it. It's probably at your local library. And besides, his blog has all the same content, just not as nicely formatted. This book is on my list of most impactful books of all time that everybody should read because he broke down how investing works in simple terms I could understand. He espouses the value of index investing, that thing that I didn't show Mr. Money Mustache say, but that he did say was invest in broad-based, low-cost index funds. What are those? The creation of index funds are credited to Jack Bogle, who founded the investment company Vanguard. He was a founder of Vanguard, a brokerage or investment company. What's a little interesting, though, about Vanguard is that it's member-owned, meaning if you invest in them, you're also an owner. This creates a good incentive because it keeps fees really low. Bogle's investing approach championed investing in broad-based, low-cost index funds. This was different than how it was before when you'd pick stocks. Instead, you were investing in thousands of companies in an index with a tiny slice of each one. This means that they don't require a lot of work. Nobody's picking what goes in. It's all just automatic, pretty much. So they're low cost. If you have someone else manage your investments, like a financial advisor or broker or something, they'll probably charge you fees, and those fees add up. Fees are killer. A 1% fee sounds small, but in reality, on a balance of $1 million, you're paying $10,000 per year. Remember how taking money out of my 401k affected its future growth? Well, it's worse with fees because those never get put back in. At least my 401k loan was paid back within a year. You could lose out totally on any potential future growth, and most brokers will charge you more than 1%. Avoid fees, keep them real low. This is something you can check deep in the bowels of your benefits tool at work, or call up HR and ask, hey, what are my fees? I'm paying for my 401k, or whatever else you have. On my leave, I took a detailed look at our financial picture using an amazing spreadsheet I found in the Mr. Money Mustache community. It's not loading. I'm going to load it up. You can actually use this spreadsheet and post your case study to the forums where a bunch of people will give you advice for your situation. So don't email me, just fill out the spreadsheet. This is what I spent my paternity leave doing. When my son was born, I finished Horizon Zero Dawn, the video game, and now after my daughter was born, I was filling out spreadsheets. But somehow, it was just as fun. I'd learned what most of all this meant through all the podcasts and books I'd been absorbing. Tax information. I promised in the abstract that we would debug taxes during this talk, didn't I? Well, let's do that because it's important. Taxes are confusing as hell. Here's how I originally thought about taxes and the income I earned coming out of college. You had your income, and some of it gets taken out for taxes. There was federal and state tax. I got that. As for the amount, well, it depended on your total income, and then that was your tax rate. Cool, that's it. That's all I really thought about taxes. Did I mention I went to business school? Hey, they taught me how to make a good resume, not silly things like how to do taxes. Okay, so I was on the right track, and there were so many terms that meant nothing to me that I didn't really know how it worked. I was thinking of paying taxes as a point-in-time event, but it's better to think of your income as a stream over time. I was in the right ballpark for thinking of different tax rates for different incomes. Those are called tax brackets. What I missed was that the full term is marginal tax brackets. That operating word here is marginal. It means that a tax bracket only applies to the portion of income it covers. That's still kind of confusing. So here's how it would work for this household making $1,000 a year. First, this amount at the end here is called gross income. It's the total amount you're paid without any tax applied to it. The other thing we need to know is how we're filing taxes. In this case, we're married filing jointly. Now let's look at each income tax bracket and calculate the tax on each portion. I'll use the 2021 rates. First, you got $0 to $19,000. That's taxed at 0%. Then you have $19,000 to $81,000, and that's taxed at 12%. Finally, we have the last bracket we fall into, $81,000 to $172,000 at 22%. But this is something I didn't really get at first. I think there are many people like me, but these brackets are not applied to your gross income. Instead, your gross income is different than your taxable income, or income you pay taxes on. But what is our taxable income? Well, your gross income is deducted by a certain amount to get to your taxable income. The main deduction you get by default without doing anything special is the standard deduction, which for this filing would be $25,000. And guess what happens to those marginal tax brackets? Well, they're applied to your taxable income, not your gross income. So because our taxable income is now under the $81,000 of the 12% tax bracket, that's where it stays. Finally, we can now calculate our tax liability, or the amount we owe in taxes. Multiply each bracket of income by its percentage and add them together to get $6,600. This is what I never understood. I never understood that these tax brackets, first, are marginal, but second, are applied to your taxable income, because I didn't know what that term meant or how deductions worked. Remember this? Remember how freaking confused I was at the difference between Roth IRAs and traditional IRAs? I didn't understand taxable income. Therefore, I didn't fully understand the differences between how money contributed to a traditional or a Roth IRA gets taxed differently. To see how a Roth IRA works with our taxes, let's introduce the terms before tax and after tax. When do you pay taxes? Since I worked at a company, I paid taxes as I earned income. My employer withholds the $6,600 over the course of a year as I work on my behalf to pay taxes. It's called withholding because I don't get to see that money ever hit my bank account. I can only see it on my pay stub. Well, that's not entirely true. You can update your withholding by filing a W-4 with your employer. Nowadays, it's usually done online. If you adjusted your withholding such that you only withheld $5,600 during the year, when you go to file your taxes, you're going to owe $1,000. Yeesh. But, and now maybe I'm about to blow your mind a little, the opposite is true too. If you withhold too much, the government owes you because you paid too much in taxes over the year. This is what we call a refund. Is the picture getting a little clear? This whole time, I thought getting a refund was great, but actually, getting a refund is what I like to call suboptimal. It's suboptimal because of what we learned about the pillars of financial independence. If you're paying too much in taxes over the year, it isn't being saved. That money is held until you file your taxes, and then you get it back. You lose out on the growth that money could earn if it was saved at the time you earned it. You're shortchanging yourself. That's why the optimal refund is $0. You don't owe any more tax, but you also haven't paid any more than you owe. Okay, back to tax advantage accounts. Let's zoom in on a single month here. Each month you earn $8,300, but $550 is withheld for taxes. But there are actually two different kinds of earned income here, before tax earnings and after tax earnings. Again, I had no idea that this was a thing. What goes into each bucket? Well, that's where tax deferred contributions go. Things like your 401k, 403b, 457b, pension, HSA. These are all automatically deducted from your paycheck. There's that word, deducted. Pay attention to it because it's going to come together in a second. What about the after-tax bucket? Well, those earnings are after you've paid taxes. These are monies that go into your checking account, savings, and also other investment accounts like a Roth IRA or brokerage account. That's why you don't have to pay taxes on Roth IRA contributions. You already did. It's why I could withdraw $5,000 for our house without penalty. I'd already paid taxes on the $5,400 I put in. And that's why there's a penalty for withdrawing the earnings in a Roth IRA because you haven't paid taxes on it. So that's more or less how the income you earn each month is sliced up, but we're not done yet. Let's pay closer attention to that before tax part. I said these contributions are tax deferred, which means you don't owe taxes on this income yet. They're deferred. And if you aren't going to pay taxes on this income yet, then you need to do something more to our tax calculation. We need to reduce our taxable income to tell the IRS, hold up, don't tax us on this income quite yet, tax us later in the future. So we can deduct all those tax deferred contributions. And it turns out contributing $1,000 per month results in us reducing our taxable income down to $62,900. That in effect reduces our tax liability by $1,400. Well now, this is interesting. Given that we know marginal tax brackets are applied to our taxable income and we can reduce our taxable income by contributing pre-tax earnings, can you guess where this is going? The question you might rightly ask is, can you earn $100,000 and end up paying $0 in taxes? And the answer is yep, you can. But you need to know the limits to how much you can contribute. The IRS has all the contribution limits for all the types of accounts you might have. Because surely there needs to be limits, because otherwise, if you can just reduce your taxable income to fall into lower tax brackets, well, that's just absurd. There are limits. Let's see how that works out in this case. When I started at General Mills, I had a 401k. In 2021, the limit is $19,500. Let's add that to the scenario. If our hypothetical person contributed the maximum amount to their 401k, it would reduce their taxable income down to $55,400. Their tax liability would be $4,260, and they're still in the 12% tax bracket. Okay, great. Wait a second. Remember when I said General Mills had an employer match for my 401k? Well, many companies offer that. Where does that come into play? Well, an employer can choose to match your contribution, and in my case, it was 3% of my salary. That isn't subject to my own contribution limit. It's a separate employer contribution limit, which is around $57,000 or so, depending on the year. They're also considered tax-deferred contributions. Since our person is contributing the maximum, which is more than 3% of their salary, they receive the full match benefit at $3,000. Their tax liability is now $3,900. We're still a bit far from that 0% tax bracket, but we're getting closer. In 2012, my wife got her job and she had a 403B. This is basically the same thing as a 401k, except for a nonprofit. Her match was 1.5%. She can contribute up to her maximum limit too. The limits in this case are individual, they're not aggregate. Since this couple is married filing jointly, that significantly changes the situation. Now we're suddenly only $10,000 away from the 0% bracket, and our tax liability is further reduced to $3,500. Surely, this is as far as we can get, right? Right. Well, there are a couple more accounts worth mentioning. When I joined Target, I got the option to have an HSA. This is a freaking superpower account. Here's why. You may know an HSA is for medical expenses. Cool. Snooze fest so far. You're young. Why do you care? Well, sit tight. You contribute to an HSA using before tax earnings. If you don't reimburse yourself for those expenses, eventually your HSA will grow. And after a certain threshold, usually $2,000, you can choose to invest the rest. Those investments grow tax-free because this is a tax-deferred account. Then at some point, anytime in the future, there's no rule. You can take out money out of an HSA to reimburse yourself for any medical expenses you paid out of pocket in the past. Okay, well, that's interesting. But wait, there's more. Like a freaking Power Ranger, after age 65, the HSA morphs into a regular retirement account, and you can withdraw any amount with no restrictions, no penalties. Oh, what? Holy shit. That's the only time I'm going to swear in this presentation. And there is a contribution limit, surely, because we contribute to our 401k. There's no way, yeah, there is a limit, but it's separate. Okay, well, we'll just go ahead and add that. And now we're only $3,000 away from not paying any tax on $100,000 of income. Don't tell me. Well, okay, so when my wife started her job at the state, she not only had a 403B, but she also gets a state-provided 457B. Now, if you're thinking, okay, it has 4 in the title, surely it's subject to the same limits as, no, it's not. You can contribute yet another $19,500 to that in addition to the 403B. I mean, at this point, I think you get it, right? This isn't a bug, it's a feature. And it's what makes financial independence tick, because when you earn money and you can stash it away in tax-deferred investments, Not only are you reducing your tax liability, you're able to build a really big portfolio that works for you and eventually pays you. You're creating a perpetual money-making machine. All right, now why am I talking to you, developers, about this? Financial independence is a privilege to even consider. I mean, consider everything I just went over. Our scenario had a household earning $100,000 and legally paid $0 in taxes. You can employ these strategies on lower income levels, but it's going to be way, way harder. You'll have to employ much more strategies in the saving pillar if you can't manage to improve the earning pillar. That requires resources, it requires time, and these are things many people are low on. Now, I'm giving this talk as a developer for developers because it's probably safe to say that you and I have these two things. I don't want to make a blanket statement, but it's more likely that you have time and resources than my brother, who works an hourly job at Starbucks, which is the situation many, many people are in. We have a privilege. We have a lot of it. So I think talking about the concepts of financial independence is useful. And as we developers have skills that we can put to use if we so choose, we can build stuff for other people. I thought that tracking my savings rate was so important, I wanted an easy way to do that on my phone. So in May 2019, I made a little web app called ReachFi. It's a progressive web app written in Gatsby, of all things, and it can sync to your Dropbox account so you can use it on any device. It works offline, so if you install it, you can always use it. Other people have created other tools, like that massive spreadsheet I showed earlier from the Mr. Money Mustache forums. There's a financial tool belt, which was created by another programmer in the FI community. There's a FI laboratory by a guy named the Mad Fientist. He's the one I originally learned about how OP HSAs are, and so much more. We as developers have the means to create tools with our own skills that could help people understand their finances better. We can also build stuff for ourselves. That's a privilege that we have. Going back to our House of FI, I mentioned that I'm a Pluralsight author and I do training courses. This provides additional income and it lets me spread knowledge. But that's not unique to developers. Many people have courses and videos, but we as developers can also build products and services. And maybe right now you're building stuff for someone else, like your employer. Developers not only can be employees. I'm sure there are some attending this talk that do contracting, maybe even have their own consulting business. We already have a lot of options as developers, but using the financial independence framework, we can open ourselves up to even more options. Remember our sabbatical, our once in a lifetime adventure that I took out money from my 401k for, the $5,000 I took out from my Roth IRA as a down payment on our house? I was robbing my future self to pay for poor financial planning. Listen, I don't regret it. They turned out okay. The decisions were based on the information that I knew at the time, but I wish I knew better. This whole time, I've been telling you what I wish I knew when I was making these life decisions, the habits and systems I could have practiced, stuff that my grandparents seemed to know, that never made it down to me or my parents because we never talked about money like this. I want to end with a little anecdote. Remember Jack Bogle? I told Nana and Tom I was doing a talk on personal finance, and the first thing Tom said to me was, "Have you read Jack Bogle's book on index investing?" It turns out Tom had learned about index investing early on when joining the Air Guard. In addition to buying their land, which they sold, Nana and Tom had been doing index investing this whole time, and I never knew about it because I never asked, it never came up. If it did, I didn't know enough to recognize what it meant or why it mattered. So circling back to the start, how were Nana and Tom's frugality connected with building their wealth? Well, now you know the answer. It was investing. That's how they never ran out of money. Their lifestyle of working part-time the years I had grown up with them, their frugal habits, they may not have known exactly about the financial independence framework, but they were practicing the mindset. Did they really ever retire? I mean, Tom worked after quote unquote retirement, but they were doing stuff that they loved. They lived a life that they loved. My grandpa Vince also retired, but it was the traditional route. The route that said you have to work 40 or more hours a week until age 65, and then you can be done. Then you have permission to be done, no sooner. I hope you can see now, it doesn't have to be like that. There is another way. This leads into an evolution of what FI that we just touched on. I focused on the mechanics of FI, but we haven't even gotten to the next level, which is how to leverage FI to do something called lifestyle design. In software design, you intentionally architect and make a plan for building software. That's really just a design mindset, and it can be applied to your life too. You can use the tools FI provides to make more room in your life to do the things you love, to make time for the ones you love. But that's a whole nother talk altogether. I've only just started on this journey 2 years ago, and I'm still trying to figure things out. I'll be sharing what we've been up to and how I'm trying to build a life we love for me and my family in my personal newsletter, which you can check out here. Otherwise, that's it. That's all I got. The key to getting wealthy isn't how much your investments grow. Compound interest takes time. How much you save matters more. So be like Nana and Tom. Earn, save, invest the rest, and live life. Thanks.
Awesome, Kamran. That was a fantastic presentation, and really highlights when you say compound interest. That today being Star Wars Day, the Force is strong, and I believe it was Einstein who said the most powerful force in the universe is compound interest. So
that's right.
Start early, start often, save early on. Thank you so much for everyone for attending. Thank you, Kamran. That was a fantastic presentation. I took a lot away from it personally. So thank you. And everybody continue to enjoy MDC 2021.
Thank you.